You think when you buy a home, you're building wealth. Every payment feels like progress. Every month feels like ownership getting closer. And that belief feels responsible. It feels stable. It feels like you're doing what adults are supposed to do. But here's the uncomfortable truth. A 30-year mortgage is not primarily designed to make you wealthy. It's designed to make the bank wealthy. And once you understand how the structure works, you'll start seeing homeownership through a completely different lens. Let's walk through this carefully. Imagine you buy a $400,000 home. You put 10% down. You borrow $360,000. Your interest rate is 6%. But here's what that really means. Over 30 years, you won't just pay back $360,000. You'll pay roughly $775,000. That means over $400,000 goes purely to interest. That's more than the original loan amount. Now here's the part that almost nobody understands. In the first year of your mortgage, almost all of your payment goes toward interest. Let's say your payment is $2,000 per month. In month 1, around $1,700 goes to interest. Only about $300 reduces your principal. After 12 months of payments, you've paid $24,000, but your loan balance may have only dropped by about $3,500. That's amortization, and it's engineered. Mortgages are front-loaded. The interest is highest when your balance is highest, which means the bank collects the majority of its profit in the early years. And here's why that matters. Most people do not stay in a home for 30 years. The average homeowner moves within 7 to 10 years, which means many people never reach the point where principal payments start accelerating. They pay the high-interest years, then reset the cycle. Sometimes they refinance, and refinancing feels smart. Lower rate, lower payment, fresh start. But here's what actually happens. When you refinance, you restart the amortization schedule. Interest becomes front-loaded again. The clock resets. The bank generates new fees, new closing costs, new profit. From their perspective, it's perfect. And it doesn't stop there. Banks often don't even keep your loan. They bundle thousands of mortgages together into something called mortgage-backed securities. Then they sell those bundles to investors. That means your monthly payment flows through pension funds, insurance companies, investment firms. Your debt becomes an asset, a predictable stream of returns. Your house is part of a financial machine much bigger than you, but real estate itself is not the villain here. Real estate can absolutely build wealth. Property values tend to rise long-term. Inflation benefits asset owners. Leverage allows you to control a large asset with relatively little capital. Let's talk opportunity cost. If you put $80,000 into a down payment, that's $80,000 not invested elsewhere. Over decades at historical market returns, that could compound into a substantial amount. Again, this isn't anti-home ownership, it's anti-blindness. Now here's where you take control. If you make just one extra principal payment per year, you can shave years off your mortgage and save tens of thousands in interest. Why? Because interest is calculated on the remaining balance. Lower the balance early, and the system shifts in your favor. If you switch to bi-weekly payments, you effectively make one extra payment annually. If you aggressively reduce principal in the first 5 years, you drastically reduce total interest paid. Small adjustments, massive long-term difference, but most homeowners never do this. They follow the 30-year script exactly as written. Comfortable, predictable, expensive. So what's the real takeaway? A mortgage is a tool. It can quietly transfer wealth upward, or it can strategically build wealth for you. The difference is understanding the mechanics. When you understand amortization, you stop celebrating early payments as automatic wealth. When you understand refinancing resets, you become cautious. When you understand opportunity cost, you think in decades, not months. Wealth isn't built by following tradition. It's built by understanding systems. And once you see the blueprint behind mortgages, you stop asking, is buying always better? And you start asking, how do I structure this to win? That shift in thinking is where real wealth begins. Because once you understand the system, you stop playing defense and you start playing strategy.